Okay, welcome everyone. Let's full start lesson 3. Today lesson we will go through our LO3 learning outcome 3, which is be able to apply taxation planning measure to minimize our deferred tax liabilities. My name is Anjum Sattar and my email address anjum@ukversity.co.uk. If you have any question, please drop me email on my email address. So we'll first, we recap what we learned during our last lessons. We discuss about ethics side, PP, popular people chat analysis. We learn about self-assessment. We discuss about parent, subsidiary, associate. Anybody know anything else, which we learned? We discuss about capital gain tax. Anyone remember anything else which we learned during our last lesson, please? Last two lessons. I can open the slide for you as well. So a bit recap first, and then we'll move to today lesson. So always good to be. Okay, because we need to cross-reference our previous lessons as well. Okay, lesson 1 was about understand the advanced aspect of taxation. That was lesson 1, where we discuss about the rates, how we can apply these rates, and we learn about the tax system, sole trader partnership limited company. We discuss about how we can allowable expenditure and things. We went through few examples, and capital allowance we discuss as well in the lesson. Okay, then accounting period we discuss role of relief as well. Basic individual self-assessment we discuss in the lesson, and that was the key, the message in the lesson 1. Lesson 2, we discuss about be able to assess the impact of relevant tax in a given situation. So we look around different situations, and we discuss disadvantages, advantages of different course of action in terms of how we can plan the tax. We look around when we do the self-assessments as well. We look around the compliance side. If we don't, so what sort of penalties can be, and if we don't keep the records as well. We discuss about assess the financial decision, maybe impact, individual when we'll do the tax planning. Annual accounting, cash accounting, various return schemes we discuss under the VAT return, and then we evaluate, corporation tax, how we can late filing and payments. We discuss. So that was the last lesson. We discuss, our lab profit and how we can, deal with them. Okay, then today lesson is about. Okay, so this will go through. Okay, current your knowledge about tax planning and ethics. What do you think? 1 to 10, please. How much you know about? Okay, I send you email. Have you received the handouts? I mentioned if you can look around the question 1 from the handout. Have you received my email?
Yeah, received the email, but didn't have time to go through it all. Yeah.
Yeah, that's fine, no problem. I will make sure, next time I'll send you well before. So we'll plan well before, so because we can go through some questions. Okay, so which we'll go through together. We'll look, how this been addressed, that scenario. Okay, so tax planning and ethics, please. 1 to 10, what do you think? How much we know? Have we advised to clients how they can plan the tax? And we need to deal with ethically and morally as well, right? Okay, what do you think?
1.
No. Okay, so maybe our current knowledge somewhere it can be 4, 5, 6. Yeah. So always good to be reflect. Okay, so today lesson we have an indicative content what we supposed to be learn, the range of different types of investment. or other expenditure may be result in the reduction in the tax liability for individual or both incorporated and corporations. Be able to advise appropriate each of these, understand legitimate tax planning, mitigation of the tax-based numerical analysis, and reasoned argument can be assessment, ethical and professional issues, current issues in the taxation can be, we have many issues at the moment, yes. Okay, so we discussed about all the rates, so always the slides for the rates will be in each lesson because we'll need to be cross-referenced. So first 3.1, we have evaluate the types of investment resulting in reduction or in tax liability. So since most of the company pay tax, the impact of corporation tax must be considered in any investment appraisal. Even you do investment appraisal, you always consider the impact of the tax or impact corporation tax. So corporation tax charge on the company's profit is the relevant cash flow for the net present value purposes. Net present value mean the cash, which we will get, what will be today date, the value of. So tax charge on the operational flow, additional income, additional tax paid, and additional cost, the less tax paid. So the tax relief on investment spending, so we have available is called writing down allowance, allowed as expense against the profit instead of depreciation. So depreciation is a non-allowed expense. So we're not looking at depreciation. So it's good to be the handout which can send you we can look around the chapter of investment to we look around the further issues so which we can explore. Okay, then next we impact of taxation on discount rates used. Normally you learn about DS, discount factors. Investment appraisal, we all okay for investment appraisal? Have you done investment appraisal?
No.
Okay, investment, the pound today, the pound will get in future. What will be the real value? And we use the various discount factor we call, yes, discount rate. So normally if we'll say 10% discount factor, so normally we use the table. We have a discount factor we call NPV PV table, which is present value. We will say 1 hour. So formula is 1 plus R. 1 divided by 1 plus R. So we can look around the money we receive. 1 divided by 1 plus R. R represent the discount factor. If we'll say 10%, so we can say 0.1. So if you do 1 divided by 1.1, so you can see what will come. What will come? 1 point divided by 1.1. What do you think? What discount factor will come? Okay, 1 divided by, you can divide if you want to, 1 divided by 1.1. So it's come 0.909. Yes. So end of first year, 1 pound value won't be 1 pound. The value will be 0.0909. Yes, you can say 91 pence. If you divide again with 1.1, whatever answers on your calculator, so year 2 will be 0.826. Yes. So on. You carry on. If it's a 15%, you can do 0.15. If it's a 16%, of course, the discount, the real value of the money. Okay. So that's, that's the way we use and which is normally we teach in the financial management side. So when calculating the weighted average cost of capital, cost of debt. So if you borrow money through debt financing, so what is the benefit for tax? So whatever interest will be, you can put as expense, yes?
Yes.
And you can minus from profit and loss, and then after that you pay the tax. But if you have equity financing, yes, so what will be happen then? So equity financing, you have to pay the tax, so the dividend will be paid after the tax. Yes, so there is no relief. Then we have a relief is only available in term of we can claim, our even we can't claim the depreciation. So writing down allowance, our capital allowance, which we can claim, otherwise we can't claim it. Huh? So that's the way we need to be look around. So this is the normal way to determine weighted average cost of capital is mean the debt and equity together if we have impact on the taxation. So that we need to be look around, project, the cash flow which will be given the rise, the taxation itself. So organization benefit being able to claim the allowance and the tax deductible alternative to depreciation. So depreciation is not allowed, like we discussed in the previous lessons as well. So the effect of these, reduce the amount of the tax on the organization required in practice. Effect of the taxation are the complex sometimes and influence number of factors. We need to look around the taxable profit rate, the company's accounting period in tax payment, capital allowance, losses available for set off, but many these issues ignored simplified the purpose of NPV, that is investment appraisal methods, which we can. Any question you can ask, please. So for the tax purposes, yes.
So that means that for most companies anyway, it's cheaper to finance some things through debt because of the relief that you could claim back, and you can claim back the cost of the interest costs and everything from the debt, but you can't do that for the equity.
Yes, equity you can't. Yes, you're right. So that's why debt is cheaper than equity and the tax implications as well. So for the tax planning side, we can say to the client, we need to look around all, that current rule for how much capital allowance you can claim. Of course, if you borrow money from the bank and any interest you can claim as well.
Yeah.
So it's a double, really benefit. So for tax, that's why some company their non-current liability in the balance sheet shows high, because that can set off, again the asset non-current. Okay, for the purpose of the business may not deduct the cost of an asset from the profit of as a depreciation, but they can, look around the written down allowance, capital allowance. We can say, either yes, reducing balance, straight line, whatever. So we can look around the life of the assets, claim early as possible, and given every year's ownership except, the year of disposal. So sale and the scrap balances we can, balancing charge can be arise, and some temporary relief we can further look around as well. Original cost of the asset, we can look around how much we have a capital allowance claim, then we have a written down value of the asset, we have a disposal value. So either we have a balancing allowance or balancing charge, that's the way we can calculate. And different term we carry on using capital allowance, written down allowance, and sometime being replaced to be taxable depreciation. So these terms carry on using. Okay, it's the same thing. Okay, next the timing of the asset purchase. The asset is assumed to be bought at T0 is a base year and could be very end of accounting period. Yes, if accounting periods are the start of another year. There is no distinction between these dates for discounting, but there is the tax. So that's we need to look around. Here, tax implications. So we can look around here, first year of ownership, the date, first year written allowance claim, and we need to proportionate. Yes, second year and if we dispose of year of disposal. Okay, then exactly when we bought the asset end of the accounting period instead of start. So that was the date. So then you need to allocate as well. It can be start and the end, and we need to be a portion and year of disposal as well. We need to be set our clear policy for it as well. Okay, anybody any question? Laying out the NPV question for the majority of investment. Of course, you're not doing exam, but if is we can look around next trading revenue, taxable, the next trading revenue times tax rate, investment, residual as scrap value, tax relief, and the working capital flows. Okay, so when you deal with these, pension or other tax efficient investment product, we can look around the pension contribution to pension scheme, enterprise investment schemes, and the tax relief under this area, seed investment, you may be heard, yes, the tax relief, or maybe you're dealing as well, yes, venture capital trust, the scheme and the trust tax relief. So further these relief, we can look under these special schemes as well, if your company is dealing with it. Okay, any question?
Yeah, no.
Okay, then next. Okay, next are types of the trading losses, and we can claim the relief. We use the word QCD. It's called qualifying charity donations. That can be carrying back 12-month current years. We can apply to the future profit, that relief, which we can if we have a loss. Relief again, the total profit before QCD, which is qualifying charitable donation, and must claim again the current year paid profit first, and then the claim again the previous 12 months, and look around and don't have made the partially claim. So we've been given sub. So our qualifying charitable donation 56,000 and trading loss is 60,000. If a claim is made, so 56,000 of the loss is used to offset of 56 of the profit, and 4,000 loss remain. And if there is a no profit left, with deduct QCD, they become the surplus, and there is a no relief for them. So this can be waste as well. So we need to be really tax planning side. We need to be carry forward. Yes, loss can be, and trading losses are automatically carry forward. Current and the carry back claims have not been made, and any loss is relief. And so that's we need to be look around. So the period, this is of course, if we can look around each April, yes, and we can go how many years? We all know up to 5 years. Yeah? So that can be carry forward. So the losses in 1st April 2017 still we can carry forward. So corporation tax pro forma, and we can look around trading income, other income, net chargeable gain, total profit, less loss relief, current year, back year, carry forward, and if we have a QCD, yes, qualifying, and then we calculate the total taxable profit. So this is all the guidance, please. Short previous accounting period if we have, and then we can allocate, in the following year those losses up to 12 months. Okay. Other factors we need to be considered choosing the relief. Does the company want relief earlier, relief, and relief as soon as possible, in which, the current and carry back claim would be preferable. Does the company want to be, you need to be look around sometime tax brackets as well where we fall, so we can save more. Any question in this regard, please? If you have, you can ask. Okay. capital losses automatically released against the current period chargeable gain if we have in terms of the gain. So research and development. What do you think, research and development? Do we know the difference between research and development? Anyone learn about IES 36? Do we know IES 36, please?
Research is regarded as an expenditure, isn't it?
Excellent.
And that the development is something that is allowable.
Yes. So if we can treat as an asset. Do we know the definition of asset? What is the asset? Which thing we can call asset? Anyone? We all know the definition of asset. Anything you own it, basic. Anything you own it is an asset. No, that's not at this level. Asset is mean anything which will flow the future economics benefit. An asset is controlled by entity, organization, which will flow the future economics benefit. So keyword is economics benefit. Yes. So like we have a COVID-19 vaccine. We did research, we developed state, everything, and the regulator passed as well. And now we at the launch state. We have a physically asset, we have a capacity, and we have a plant, and this will future. Then we can put as an asset in our whatever the money we spend on it, development or research, we can measure reliably, and then we can put it as an asset that, and again that we can claim the capital allowance, which that's for the tax purposes as well. So SMEs can deduct an additional 130% qualifying expenditure for the purposes for every £100 spent on the research and development. The allowable taxable deduction, original £100 plus further 130. So total relief is 230%, the £100. If the deduction create a loss, surrendered the cash payment from the HMRC 14.5% amount. Okay, that's further area, research and development. So there can be various issues, so we need to be look around. Is it qualifying period? Is it qualify or not? The pension service company, we know IR 35. Are we dealing with IR 35?
Not yet.
Yes, please. Okay, so this is anti-avoidance legislation, often called IR 35.
Are we talking about off payroll?
Yes, some relief as well. The companies, like umbrella companies and all. So, and plus now NHS, like paying to doctors on, and the declaring side, to whom they paid and how much they paid. Anyone else, any ideas about IR 35? Of course, no, is going to be still, because the last year is supposed to be due to the COVID being delayed. So a personal service company, we know all umbrella companies, yes?
Yeah.
So has just, one shareholder use the company to provide his or her service to clients. The legislation apply when PSC, personal service company, is used is an employment relationship, and tax, especially NI, can be avoided by owner if they withdraw money from PSC in dividend rather than salary. So that's one. Okay, the client, service provided by the worker to clients, and ownership shareholders, PSC, and the shareholder is the worker and the worker. So the legislation is only applied to the relevant engagement contract between company and the client, which would have been contract of employment in the absence of PSC. Okay. IR 35, the client company is not affected. PSC has to be treated the income from the relevant engagement arising in the tax year, and if they paid out the salary to employees, account for the income tax and NI notion salary. We need to look around the treat the salaries as if paid at the end of the tax year, and only deductions for the salary paid and the expense typically allowed to employees plus a flat rate 5% deduction. So signs of relevant engagement include the worker cannot send substitute, worker is provided with the tools and equipment by the client company, the client company gets hours to work. PSC has only one or two clients. Okay, that's the tax treatments.
I have a question.
Yes, sure.
What happens if there are two directors or two shareholders? Does the same rule apply?
Two directors,
or two shareholders. Does the same rules apply?
Yes, should be apply the same rules, yes.
Oh, okay, no worries. I just looking at the chart when you just mentioned one shareholder. I didn't know whether there was a kind of a loophole if there was two shareholders.
Yes, can be. Can be. It's a further need to be really look around. So further, if we want to explore, please. So that's a bit new as well. Okay, go on the gov.uk and IR 35, please. Latest release. Okay, so which we can, I'll try to send you article. We can look around further. Okay, next please, 3.3 evaluate the mitigation of the tax for individual and the businesses. So when you providing the tax planning advice to the client, you are fully responsible for the advice you give. So what is the fundamental principles we need to be keep in mind, which is professional competencies and due care is relevant here or not. Anything you recommend must be legal, and you must understand the basic distinction between the tax avoidance, tax mitigation through the legal means, the tax avoidance which is illegal, such as failing to disclose relevant information or providing false information. You must suggest arrangement which HMRC will disagree with your conclusion as the tax consequences. You need to explain to client that the full detail must be given, enable HMRC to consider the matter, and you should warn them that any negotiation with the HMRC will take time and incur expenses. And make sure you know the time limits for any claim that need to be made, and such claims made within the limits. Okay, so I copied the link here, please, for further. Yes, is a technical article to look around. Any question on this regard?
No.
Okay, then we already know the tax is attempt of the tax is treated as a fundamental principle of integrity. Integrity means honesty, so professional behavior can be compromised. It may also be subject to the criminal charge under the board tax laws and the money laundering legislations. So that's why every accountant has the course, yes, money laundering legislation and up to date. So you have following responsibility if the client fails to provide informational request by you, for example, preparing return or the calculation, you need to be considered whether you continues to be act for the client, or you should advise the client to make full disclosure to HMRC, or authorize you to do errors exist and the information already submitted to HMRC. The client refuse, and then you can no longer act for them, and you must inform to HMRC that you are no longer acting for the client, but you are not under the obligation to explain why. It's not compulsory, you will explain to. Okay, whether or not feel able to continue that of the client, and you're still under the professional duty, ensure the client understand seriousness of offense against the HMRC. Okay, direct tax avoidance scheme promote the tax avoidance scheme relating to the tax, direct tax, income tax, national insurance contribution, capital gain tax, corporation tax, inherent tax, stamp taxes have disclosure obligation, and there is also an obligation on the taxpayer to disclose the details of the scheme in the certain cases. Notification is required when promoter of the arrangement propose arrangement. The main benefit of the tax to enable any person to obtain an advantage in the relation to the tax. The taxation is defined as a relief or increased relief from the tax, and repayment or increase the repayment of the tax and the avoidance of the reduction of the charge. Anybody any question here? So any person fail to comply with the disclosure provision of the liable to a penalty not exceed the 5,000. If the failure to continue after the penalty has imposed, the person is liable for the penalty or penalties exceeding 600 each day for the failure continue. So that can be, and value added tax avoidance scheme, business using VAT avoidance scheme must be disclosed their use. So we need to be, and that can be penalty again, up to 5,000. Or we need to serial tax avoidance. We can look around as well. Taxpayer who more than one tax avoidance scheme, which been deferred on the 6th April and may be classed as the tax avoidance by HMRC. Defeated scheme is one which either the taxpayer is reached and the agreement with HMRC, so tax advantage that would have been expected under the scheme is not available. So that's specially arrangement can be, and we need to be look around the legislation. That's advanced scenario can be, and we need to be give the advice to the clients accordingly. Yeah? And always we need to keep in mind the ethics. If any question you can ask. So next we have a 3-point merit criteria. Here we need to evaluate the professional issues arising from the given tax planning. So tax planning is illegal. Yes, any question?
Yeah, no.
Okay, so next we're looking ethics, so fundamental, disclosure information, conflict of interest, tax planning, prospective clients, tax irregularity, any the issues, and the money laundering and the tax avoidance schemes. These we can look around. Okay, then when the tax ethics avoidance scheme, fundamental principle we need to disclosure information, all details we can follow. And the tax avoidance schemes, and the penalties all being summarized what we discussed in the previous slides really. Okay, so these are all, and we know what are the ethics. Yes, 5 professional code of ethics, and then we can look around the 5 threads can be. So self-interest. What is a self-interest? Do we have any self-interest? Or can be self-interest? Any example of self-interest? Having a financial interest in the client business, you have an investment in it. You can't really do or prepare accounts. So depending upon the client fees, significant proportion is coming from one client. You saying the client is saying, I'll leave you, I'll move to the other accountant. So because the self-interest involved, family or relationship can be, can we charge contingent fees? What do you think? Okay, whatever I'll save you in tax, 50% you have to pay me. What do you think? Is it illegal or not legal? What do you think? Can we say to client, whatever the tax through tax planning,
It's legal.
It is illegal.
It's illegal. Yes, we can't do contingent with the condition attached with it. We only charge the working time. Yes, it can be whatever rate you decide. Yes, the market forces and your expertise in those areas. Self-review, checking your own work. Yes, if you was before bookkeeper or you was accountant submitting the return. So that's also it can be compromise our ethic, these risks, so we need to be reduce them, and we have to be familiarities, close relationship. We know each other. We getting gift. Can we get the gift, from the client?
No.
Why not? They say hospitality, come on, Yes?
It could be seen as a bribery.
It can be bribery, yes, if we do the wrong thing. But they say, it's hospitality. What we do, how we can use it? Is there any guidance for gift? How much gift? How much worth of the gift?
I'm not too sure. Is it £50?
Yes, there is a normal people suggest 50 up to £50. But as a law, if there no such guidance, what you need to do, you have to use the professional judgment. Yes? Why they giving you? Why not giving to other your colleagues, for sport? Yes, why they specific? Because you're dealing their matter. That's why they're giving you. Yes, they're offering you free holidays. They're offering you uh, discounted rate, the marriage hall or something. Yes. So we need to use the. We just need to use the professional judgment. We need to put the safeguard in place. Yes. So with our professional code of ethics, not compromise. Okay. Then sometime intimidation that can be also compromise the professional ethics. So your job will be risk if we don't do it. Yes, this and that. You have to make sure you use the, and we're not supposed to. Advocacy. Sometimes you're giving one client advice and other client they are competing with each other. If you give one advice, you're missing others. So it's better to be you draw the safeguard and refer to someone else. So we need to draw the safeguards and remember in practice or remember in business, all we need to be follow, and we should have a policies against these to protect and the professional ethics, not compromise. That's all about. Any question, anyone?
No.
Okay. Next we have, this is the big scenario which I send you, review current issues. There can be many issues. Yes. What do you think at the moment is most, issues at the moment? What is the big issue in tax? What sort of we heard about people not paying the fair tax? Yes, some, especially the businesses maybe with the respect. Yes, not everyone, but lot of and that's why is more things going to be digital. Yes, lot of things is going to be changed. IR35 and further enhance is one. This is all about. Okay, so this is the case which I send you, which we pick from one of exam paper of ACC. So if you want to be look around different scenario, and you want to be really, if you're dealing up to those issues with your client, you go type Google search ACCA old exam paper advanced taxation. So you can download the scenario which I send you one paper today in the email, and that's the in the email. So this is, we have your managers have received an email from and there is a managing director and majority is shareholders in this company, and then of the client of your firm, and your managers forward the email to you to gather an email and detail of the work you required to do. So this is all about the scenario is quite big. Of course, we need to look around, So always we've been given all the issues. Here, all the tax, property, investment, proposed gift, of the shares to the trust. And the inherent tax elements there as well. And then we've been asked, the knowledge obtained from the advising to other clients, investment in J Limited if they have, and residency test, how we can apply for to check, and control foreign companies. We discuss about parent, subsidiary, and other associate elements, and purchase of investment properties, proposed gift, and then we've been asked, knowledge obtained from the advising clients, investment, residency, election exempt profits, in that case, overseas establishment, foreign companies, purchase investment. So these are all normally in exam, 30. So there are the many issues. So to address it. So in term of our assignment purposes, we can pick any and we can discuss, So I already send you this one in your mail. So just 1 second, I can share with you. Okay, so this please is it's maybe so next time I'll send you, these sort of 1 or 2 questions to look well before. So that's, is please, if you can, before next lesson, if we can look at this and then we can discuss. So like here, knowledge obtained advising other clients. So we have experience of advising clients from permanent established situated overseas. So you are replying the email. Okay, so thus we can deal confidentially. We are following the code of ethics of ACC or any other awarding body. Investment, residency, taxation. So the profit for the business will be generated in this company regardless resident. So according to the profit will always subject to the business tax of, in that case, 13%. So if the J is the limited, is the resident in UK, the profit would be subject to the corporation tax because the permanent establishment PE. So it's not separate legal entity, and the UK resident company are subject to the corporation tax, their worldwide profit. So however, the double tax relief would be available amount payable in the UK would be 6% and 13% abroad. Yes, that's, we can, and that is the scenario we've been given. So the profit less, double taxation relief. So that's the scenario for overseas relief and the issues how we can tackle. This has all been explained. Election to exempt the profit, J overseas. So election available is available the UK resident company which generate the profit from PE situated overseas if the J were to be make this election. So if the profit in there is no longer be subject to the corporation tax, if the election is made in the UK corporation would be payable on the profit rate 6 after the double taxation relief. No relief is available. The UK respect any losses generated activities in. So these are different scenarios. We need to look around and then we have to apply it. Then we have a purchase or investment. The rule we need to look around. Okay, then inherent tax, yes. Transfer assets from. So please, if you go through before next lesson, this, the question, look around all the calculations, and then we can further discuss if any issues. Any question, anyone?
No.
No.
Okay, so that's all, today lesson. Please, if you have any question, you can ask, and we can look around in details, yeah. And to enhance, always good to be look around because sometime is advanced level, it can be different issues in different scenarios or your scenario of the client. So go back to the legislation and look around, and then you advise your client. Sometime maybe we need to be professionally competent and do care, but the things are carry on changing. Maybe you're not up to date everything. So always gov.uk is a useful source, and otherwise, if you want to look around the Finance Act and look around even you can consult ACCA, advanced taxation legislation, and article is good to be. And I'll send you some, all the issues carry on happening, which need to be carry on up to date with it. And it's absolutely free. You can download. Okay, that's all today, and I'll speak you next week, which we'll go through. Thank you.
Okay,
Thank you, Angela.
Thank you. Bye-bye.
Bye-bye.